The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. Investing involves risk, including loss of principal. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. People of Chicago, you're tuned into In the Know Radio, a show about money, investing, retirement, and life with your hosts, Craig and Leslie Bolanos, co-founders of Wealth Management Group.
It's time, America. Get your game face on.
Put your savings to work and finance the lifestyle you want with real advice from real people.
You're emotionally tied to your money.
Separate the confusion from the facts to get prepared for whatever comes your way and get it right here.
You got to make sure you've got plans for a rainy day.
What's the number you need to live out your retirement dreams?
$60 billion.
Holy cow!
Wait, did Leslie really just say $60 billion? All you need to know is that Wealth Management Group is in the financial planning business, so you can be in the fun and retirement business. So get your retirement on, people. Their phone lines are always open at 833-WMG-PLAN. Now, here's Craig and Leslie.
Hey, good morning and a very happy Sunday to you. Every single week, we aspire to deliver you sincere and actionable ideas, the type of ideas that you can use not just to get retired, but to stay retired, because no one wants to survive retirement. You need to thrive in retirement. And what is retirement? It's seen as a time to enjoy the fruits of your labor. But if you don't have a well-rounded strategy, that retirement can bring unexpected challenges. I mean, we've got changes in interest rates, just lowered interest rates for the third time this year on the 18th of December. President-elect Trump just did a nomination for a new IRS commissioner. And there's this surprising link, although I don't think it's too surprising, between healthcare and happiness. And hence we got to talk about the plan to be aligned with our finances for our future self. Our number, 833-964-PLAN. That's 833-964-PLAN. Jump out to our website, getretiredstayretired.com. That's getretiredstayretired.com. You know, as we come into the end of the year, I'm reminded again about the simple fact that if you've got people that you love and they love you back, then you absolutely emphatically must have an estate plan. I mean, think about all the famous celebrities who have passed away without an estate plan. You know, Aretha Franklin, Bob Saget, who passed away in 2023, Norm Macdonald from Saturday Night Live, who died in 2021, Gilbert Gottfried, who died in 22. In fact, the list is long, the list is distinguished, but why did all of these celebrities, A-listers at one point in time, even think about Prince, why did this occur? What happened? Did people not have access to attorneys? Of course they did. It was nothing more than procrastination. And I know this because we do estate and legal work in the office. We do settlement in the office. And now is the time, not next week, not next month. Right now is where you commit that in January, it's not going to just be dry January. Nah, don't do that. It's no fun. It's going to be estate plan January. And here are the basics. There are documents that you need while you're alive. That's your durable power of attorney for healthcare. That's where you're naming not an executor, not a trustee. You're naming an agent. That agent is going to be your advocate. That's going to be the person who's in charge of making decisions if you can't make them for yourself. Decisions like quality of life versus quantity of life. The ability to get clear, unencumbered access to your medical records, to seek what I call second opinions and develop that coordination of care. So the first document you need is going to be a durable power of attorney for healthcare. But you don't just name one agent. You should name several. And you should build in or do as an addendum to that durable power of attorney for healthcare. You should build in HIPAA waivers, because you might have people in your life that you want to be able to be informed. People in your life you want to be able to talk to the provider, AKA the doctor, but they're not decision makers. And you can use that HIPAA waiver to grant that ability to communicate to your attending physician, but just to communicate. So in my example, I'm married to my best friend in life. She's my wife. Her name is Leslie, and Leslie is my primary agent. And then by now, if you've been listening to the show for the last 14 years, you know that we've got two boys, Connor and Gavin, and they are successor agents. But I've made sure that I've included a HIPAA waiver for Connor and Gavin so that they could call in and find out about my condition, or they could help mom with the coordination of care, even though they're not the decision maker. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. We're talking about all these celebrities who died without an estate plan, and we just vowed to not let it be you. So we talked about the documents we need while we're alive. That's a durable power of attorney for healthcare, where you're naming an agent. You're also going to do a durable power of attorney for property. And here are some ways that document is key. So many people have 401ks, have IRAs. If you're like me, my beneficiary is my wife, Leslie. But if I'm sick, injured, or encumbered, while Leslie's a beneficiary, she has no legal right, no access to withdrawal or make decisions on that IRA, because the I in IRA stands for individual. So I did a durable power of attorney for property, which will cover things like my IRAs, workplace retirement plans. And I specifically want the extra step to endorse financial institution transactions. You should do that too. 833-964-PLAN. Now, after the documents we have that were alive, everybody has a document that's used at death. And regardless of whether or not you do trust work, everyone gets a will. For some people, it's a standalone will. For other people, it's going to be a pour over will. But the bottom line is, in a will, you're not naming an agent. In a will, you're naming an executor. And that executor's job is settlement. Clearly, I've been married a lifetime. My executor is my best friend in life, my wife, Leslie. Our kids are then successor executors. So if you don't have a will, get one. Because if you don't have one, then your estate's going to get divided by whatever the law dictates of your state of residency. So as an example, Bob Saget, great guy, Full House. Who didn't like Full House, the comedy show? When he died at the age of 65, in 2023, again, he didn't have an estate plan. His estate was divided by California law. That lack of a will totally led to disagreements with his family over asset distribution. It is still not settled as of December of 2024. You don't want that. You don't want the state dictating where your money goes. You dictate where your money goes. That's why you're going to get a will and name an executor. We can help. 833-964-PLAN. That's 833-964-PLAN. Or visit us on the website, getretiredstayretired.com. Now, if you've got people that you don't want to just give money to, but you want to message, because remember, I think estate planning is about messaging. Messaging means we're putting people that we love in a position to be successful. You might want to pair your power of attorney for healthcare, power of attorney for property, your will. You might want to pair those documents with a trust. Specifically, something like a revocable living trust. And the reason you would do that is that revocable living trust is designed to help you avoid probate. That revocable living trust when inclusive of credit shelters, is going to be designed to help you avoid, if not mitigate away, death and transfer taxes. And most importantly, that living trust is how you'll message. So for me, it's simple. Everything I have goes to Leslie. Thereafter, everything goes to my boys equally. But I want my monies to go through the bloodline. I want my monies not to be subject to a divorce in the future if one of my boys got separated. I don't want my monies going to a creditor if one of my boys had a creditor at the time we died. I also don't want my boys getting access to all of their money today. I mean, my boys literally only turned 24 and 22 in the ensuing year. They're still young. So I think my boys should have access to all the money they need for their health care, education, broadly defined maintenance and support, but their ability to spend with discretion. If me and my wife, Leslie, are gone, that should be curbed. They'll get access to some of the money at 25. Some of the money at 30, the balance at 35, kind of the old 3 strikes, you're out. But that's an example of messaging. So if you want to learn more, you can. In fact, I wouldn't think you should. Connect with us. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Or call us at 833-964-PLAN. 833-964-PLAN. And let's make this coming month, January, the month that you commit to procrastinate no longer, that you commit to put yourself and the ones you love in a position of advocacy and worry-free if you became an angel overnight by getting your estate plan curated. And people shouldn't get boilerplate documents. You should get something that's unique and custom, because that is what your family is, unique and custom. It needs to be something bespoke, and we can help you do just that. 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. More to come. AM 560, The Answer.
In the Know Radio with Craig and Leslie Bolanos, where their goal is to pummel you with financial know-how until you say uncle.
If retirement was easy, I wouldn't do this radio program. If retirement was easy, we wouldn't serve families across 41 states. Retirement is no longer easy. My heavens, do I wish to go back to the good old days, the early formative parts of my career, where you had affordable retiree health care. Yep, affordable retiree health care. Typically, people would have a pension. They'd have 2 Social Security payments. And then best of all, they had a portfolio, and they probably weren't living into their mid to late 90s or over even 100. The retirement planning process was simpler because life just felt more finite. But now you think about retirement planning, tomorrow's promised to no man and no woman. We've all been touched by that. But the reality is, if you're going to be unemployed for 20, 25, 30, 35 years, how do you make sure you don't run out of money? And you know what? Having money isn't a prerequisite to being retired. Having a strategy is what allows you to be retired. Because in the last segment, we talked about all these celebrities who died without an estate plan. What about all the celebrities who've had to come out of retirement because they ran out of money? I mean, Jim Carrey, he ran out of money in retirement. Yeah, that's why he popped back up on the circuit here in the last year. There's other people that have run out of money. Nicolas Cage, Hugh Grant, Al Pacino, these are widely publicized. So go figure. Running out of money is probably the most scariest condition that people face when they go into retirement. So let's talk about what you need to do, because we're going to all commit together to make 2025 our best year ever. by helping us create a better version of ourselves, and in this case, our financial landscape. So when we talk about retirement planning, I think the first thing is to be realistic. Your plan has to be realistic. What are the income sources that you're going to enjoy? What are the obligations that you're going to have? And the price that someone pays to being retired is having to have an increased situational awareness. Because when we're working, we've got current income. We can oftentimes earn our way out of problems. But once we are retired, that's it. It's game over. You have to have awareness of the boundaries. And that means how much you can spend. And whether someone is using the 4% withdrawal method, whether someone is using something called dynamic withdrawals via bumper guards, whether someone is doing some form, here's what matters. What matters is that you have a process. What matters is that retirement planning process for cash flow is TNT, tested in the trenches. It doesn't exist on some whiteboard. It exists in all forms of practicality. And what we've done at our firm is we've long talked about those 3 pillars of retirement income. And we revisit them here, closing out 2024, because it's what you need to have in place. First, you have to have a plan to protect that nest egg. You got to have that protection, because once you retire, all you have is pretty much all you're ever going to have. You need to be so focused on the return of your capital, not just the rate of return on your capital. Because you've seen the horror stories. You've seen people who overinvested, overcommitted, didn't realize the amount of concentrated equity risk premium in their portfolios and gotten blown up. You saw it in the dot-com bubble. You saw it during the failure of long-term capital management. You saw it during the Great Recession. You might have seen it as industries completely changed as a result of the pandemic. I mean, this is a constant, gang. You know it, and so do I. So let's make sure, if you're going into retirement and you don't want to get unretired, what's our website? Get retired, stayretired.com. That means you got to have that plan. And pillar number 1 is capital matters. Pillar number 2 is retirement isn't about the nest egg. Retirement is about cash flow. You know, the analogy I use is there's a lot of people who love rental income, because when you have rental income, you're only spending the income. You're not touching the building, the condo, the house that's being rented. You're just spending the net income after you pay expenses. And we think that your retirement plan should follow a similar parallel. And that's why pillar number 2 is you generate sufficient portfolio income to cover the dividends, with interest, with distribution, your monthly spend. So if you require $7,500 a month after taxes, then you best make sure you have a plan that your portfolio, which is inclusive of things like Social Security and other forms of payment, you got to make sure that your portfolio is at least distributing $7,500 a month of dividends, interest, and other payments, so that you never have to touch the principal. Because if you can cash flow your spending, then when those periods of time of volatility inevitably erupt, and they're going to over a 2 to 3 decade retirement, you're never going to be forced to sell anything when prices go down. And that's what's key. It's being able to cash flow that portfolio. We're talking about, if you don't want to get unretired, like far too many celebrities have had to go out of retirement and go back to work, then you need to have a plan. And that plan needs to be tested in the trenches. It needs to be systematic, repeatable process. And the strategy that we've used for clients in 41 states now is exactly that, tested in the trenches. It begins with preserving your capital base. Capital matters. It then transfers into generating sufficient dividends, interest, and payments to support your monthly spending. So you never need to touch the corpus. You don't need to sell shares. And then you got to focus on part number 3. I hear all the time that people buy annuities. And there's nothing wrong with buying an annuity. And if you want a portion of your money to be in an annuity because you don't have a pension from your workplace, that's fine. But the danger out there in today's environment is there are not too many annuity contracts that grow your monthly income once you start taking withdrawals. So the amount of monthly income that you get from your annuity might be adequate today, but will it be adequate in the future? I mean, think about this. If you're going to be retired at least 20 years, check your property tax bill today compared to 20 years ago. I'll bet you it more than doubled. You know it more than doubled. And if you are getting monies simply from annuity contracts that might not grow your income once you start cash flowing from those annuity contracts, then how are you going to pay your future property tax bill 20 years from now? You're not going to be able to. You got to have strategies that grow your capital base over time so that you can grow your income over time so that you can outrun the silent killer that is what? Inflation. Inflation is the silent killer. Don't let it mow you down. So you got to have all 3 pillars of retirement income if you want to get retired and stay retired. And I invite you to learn more. You should learn more. You should want to learn more. Connect with us online at getretiredstayretired.com. Getretiredstayretired.com. Pick up the phone and give me a call. 833-964-PLAN. That's 833-964-PLAN. We exist to help people just like you work through the necessary steps to create a well-vetted strategy. It's a strategy that addresses your taxation in retirement, your retiree health care, help solve for what we talked about earlier in our first segment today, your estate plan. It's a strategy that's going to include those 3 pillars of retirement income that are tested in the trenches. And all of that supported by a very robust, proactive service model that's delivered from all these professionals under one roof, because everyone deserves a family office. We believe in a family office for everyone. We're not going to walk your dog. We're not going to buy you concert tickets. But if you're just a great American, a patriot, someone who wants to protect the Constitution, someone who's just trying to do better, to take care of you and yours, then it's time you work with like-minded advisors. More to come. AM 560, The Answer.
Want more In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Yeah, you can. Welcome back. Here's more with Craig and Leslie.
Well, I think we're going to end up getting a new commissioner of the IRS. So what does that mean to you if we get a new commissioner of the IRS? Well, part number 1, the newly nominated commissioner would be Missouri Congressman Billy Long. Now, he is not a CPA by trade, does not work for the IRS, which means he's a bit of an unconventional pick by President-elect Donald Trump. But you know what? That shouldn't surprise anybody. It's about shaking up the system. And yes, he's had a bit of a controversial reception because, people are concerned about potential reductions in tax enforcement enforcement, especially those that affect middle-class taxpayers. But let me tell you what Congressman Billy Long, the nomination for the IRS commissioner, is in favor of. An absolute focus on small business. He has worked himself as a business, as an advisor, and assisting small businesses with IRS compliance. I think that's a big deal because small businesses drown in the bureaucracy of regulation. In addition, he's really focusing on potential policy shifts. I mean, Missouri Congressman Billy Long has a long history of advocating for reduced IRS authority, especially when it comes to certain tax planning strategies that might affect retirees. He has long supported abolishing estate taxes. That's a very, very big deal. I don't know if it's going to influence congressional decisions when everyone tries to raise revenue, which is a nice way of saying raise taxes, and the death and transfer tax does that, but at least he's friendly. And I think one of the other things I heard him say when President Trump first nominated him is advocacy for going further than the Tax Cut and Jobs Act did to simplify income taxes. And why does this matter? Well, I think people's single largest expense is not their mortgage. It's not the adult kids, although the adult kids are a close second. Everyone's single largest expense is TIR, taxes in retirement. You're getting taxed on your Social Security. You're getting taxed on this, taxed on that. It feels like it never ends. And certain things that you thought might be tax-free, they're not even tax-free, depending on where you fall in the income spectrum. Just ask wealthy investors who buy tax-free muni bonds only to have that municipal bond interest count towards their Medicare premiums being more expensive through IRMA. But here's what you can do. You can start being more tax efficient today. And how do you do that? Well, I think it starts by having conversations with professionals who know the leverage starts with income taxes. Income taxes is not an end of the year thing. It is not a preparation thing. Income tax planning and strategy is an everyday thing. It is. It's an everyday thing. Let's talk about how you make it every day. Number one, asset location. There are certain types of investments that you should hold in certain types of accounts, and there are certain investments that you should never, ever hold in other types of accounts. I could give you a ton of examples. An example might be you don't want to own things that generate K1s inside of your IRA, lest you want to be subject to unrelated business taxable income, UBTI, in your tax sheltered IRA. That would be terrible. Another thing, this time of year, warning, Will Robinson, don't be buying equity mutual funds in a non-retirement account in the month of December. Why? You might get a phantom income tax bill when that mutual fund distributes a capital gain. Next thing on my list, are you properly choosing, if you're in the 10 and 12% bracket, Roth IRA and Roth 401k every day of the week? If you're in the 32, 35, 37% bracket, odds are you're doing pre-tax contributions. But if you fall in that 22 to 24% marginal bracket, you're stuck in the middle. That's right. If you're in the 22 to 24% tax bracket, you're once again stuck in the middle. You got to do all this math to figure out where your credits and deductions start and end. Those are called phase outs. You got to look at where your credits and deductions just cliff test, meaning you're $1 over, you're out. And the vast majority of Americans are there. So it's so critical if you find yourself in that 22 to 24% tax bracket that throughout the year, you're working with professionals who can help you make sure you don't get disenfranchised from your AOTC. I didn't say AOC, that's a joke. I said AOTC and things of that nature. 833-964-PLAN. That's 833-964-PLAN. And going into the end of the year, I talk time and time again, pounding the table about portfolio rebalancing. And one of the best ways to rebalance is to rebalance without realizing gains. How do you do that? I call it cash flow rebalancing. Make sure you and your advisor are directing new contributions, new deposits into the asset classes that are now underweighted in your portfolio. That's a great way to bring things back to light. Part number 2, if you're doing tax loss harvesting, don't go uninvested for 31 days. Make sure you tax loss harvest the security, instantly replace it with a similar but not identical security, and then consider unwinding that loss and swap trade on day 32. I already mentioned considering asset location time and time again and putting those assets that are not necessarily tax friendly into the right type of accounts. In fact, here's an idea that I think lots of people should do. I mentioned 2 weeks ago that maybe, just maybe, bond investors are ready to grow beyond the world of bonds. Maybe income investors of all shapes and sizes want to grow beyond building a portfolio of individual bonds in a ladder or a bullet strategy. Maybe people are ready to start incorporating some private credit into their investments. Because for those investors who qualify, the world of senior secured lending, private credit, with its 8.5% to 9% distribution rate, could be a great way to cash flow. And what if you were doing those distributions through your Roth IRA? Said another way, you're literally receiving tax-free distributions that you can use to flow your retirement. I mean, who wouldn't want to do that? And if it sounds gimmicky, it's not. It's just real. And that's one level of how you take some tax planning and marry it with asset location with the right investments in the right types of accounts. Here's what I think. Going into the end of the year, we talked today about how everybody needs an estate plan because we looked at all these celebrities who died without one. And gosh darn it, we're all going to get one in January if we don't. And then we talked about getting retired and staying retired because we don't want to be like these other celebrities who have ran out of money. And that takes a disciplined strategy of systematic, repeatable processes that are tested in the trenches. And just now, we acknowledge that everyone's biggest expense is income taxes. And for many, it's taxes in retirement, TIR. And I have some hope that President-elect Donald Trump's nominee for the IRS commissioner is going to make things easier for small business, makes things simplified for all of the citizens. But that doesn't mean we wait. It means we run to the fight. We take control of what we can take control of today. And those are things we do, and we do them well. I'm Craig Bolanos. I want you to learn more. You can connect with us via phone, 833-964-PLAN. That's 833-964-PLAN. Or go to our website, getretiredstayretired.com, getretiredstayretired.com. More to come. AM 560, The Answer.
Good, because Craig and Leslie are back, and they're about to crack some eggs of retirement knowledge all over Chicago. Back to In the Know Radio.
Let's be sincere. There's no better place to invest than right here in America, in the red, white, and blue. I sometimes refer to this style of investing as putting monies into great companies of America. And when you invest in great companies of America, it's been a long, proven track record of wealth building. So, the goal of, I think, everybody is ultimately to achieve financial security. And one way to do that is to partner and align for long-term growth by selecting quality businesses. And what's a quality business? It's the type of business, it's a company that has the ability to influence their own markets through their vision, their adaptation, their initiatives. And quality businesses, they tend to adhere to their own core competencies. They know their identity. They're true to themselves, and they are always led by excellent management teams. And an easy way to spot and view these great companies of America is oftentimes they're cash cows, which means they have a tendency to have very high free cash flow. And companies that have very high free cash flow, well, it's a great indicator of their financial strength and durability. Because when you're generating positive free cash flow, it simply means the company is generating way more cash than it needs to run their businesses. And when you've got great free cash flow, it means the business, the leadership can invest in growth companies. So these companies that generate high free cash flow yields have the ability not just to invest for growth, they have the ability to actually invest in their dividends and correspondingly grow their dividends over time. And we believe here that strong risk-adjusted capital returns occur through good bottom-up stock selection, fundamental research, disciplined valuation approach, leading to a long-term vision that's incredibly tax efficient with low portfolio turnover. Those are the hallmarks of how we invest in great companies of America. And if you want to learn more about what I call these cash cows, these companies with tremendous free cash flow, and how you can use their current dividends and their potential for future dividend growth to help satisfy your second and third pillar of retirement, connect with us via phone, 833-964-PLAN. That's 833-964-PLAN. Or go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And all of this leads into my year-end do's and don'ts when it comes to retirement. And my first list of do in rapid fire is, do you know how much income you'll actually need from your investments? That means you have to have a budget going into retirement. You need to tell your money where to go instead of wondering where it went, because getting the cash flow is the single most important ingredient when it comes to baking a wonderful souffle. A souffle in this case of getting retired and staying retired. And number 2 on my quick do's for retirement is do prepare for the unexpected. Remember, preparedness and flexibility are basic table stakes when it comes to retirement planning. And that means you need to move into retirement not just with a nest egg and a portfolio, but dedicated emergency funds and ample cash reserves, because life, it's got a way of kicking us. And sometimes life even kicks us when we're down. So you need to make sure you've prepared for that. 3, on my list of do's for retirement, you do have to maintain a dynamic retirement plan, because the best retirement plan is one that's well laid out, identifies your strengths, your opportunities, but it also provides for mitigation against threats. The world is constantly changing, and plans need to address those changes in real time. That's why you need to partner with a proactive advisor, not someone who's going to be reactionary. It takes proactive management to navigate the speed through which markets and economies change. Now, what are some of the don'ts? Don't, when it comes to retirement, don't ignore inflation. I mentioned earlier today, there's nothing wrong with having a portion of your money in an annuity contract to generate the pension you wish you had from a company. But if your annuity contract by itself isn't growing that monthly income, then 10, 15, 20 years from now, boy, those annuity payments are going to be insufficient. So you need to make sure you have a plan to double, if not triple, your capital base in retirement, because you've got to have a plan to grow your income through retirement so you don't end up having to go back to work like some of the celebrities we talked about in our second segment. On my other list of don'ts when it comes to retirement plan, don't fall in love with what recently worked, as what recently worked might not work tomorrow. I mean, it's so tempting to think the last 3 to 4 years worth of returns are going to be equivalent to the next 3 to 4 years worth of returns. It doesn't work like that. That's the concept of recency bias. You can't be thinking that what happened in the past is necessarily going to happen again in the future. And remember, there was a period of time where the S&P 500 went into a lost decade. There was literally a decade-long period of time in the United States, not that long ago, where from point A to point Z, the S&P 500 literally made no money. Now, yes, is a big part of that because the Great Recession was a part of that 10-year period? Of course it was. But don't say never, because history has a way of repeating itself, or at least rhyming. So remember, the only free lunch when it comes to investing is to be diversified. And you can't just be reactive. You got to be proactive. And that leads me to number 3, when it comes to retirement, don't get emotional. Fear, greed, regret. They're all the enemies of a well-laid plan. Be disciplined, systematic, repeatable process to help ensure your odds of success when you deploy those strategies that are TNT, tested in the trenches. And I would argue you can't get it done in a solo advisor model. You need to work with an entire team of advisors, a team who is all under one roof, because your retirement can never go on vacation. People need to constantly have vigilance. That's why we have a dedicated trader, a dedicated financial planner, a dedicated insurance expert, a dedicated cash flow modeler. We have someone who handles the estate planning, someone who handles the tax, someone who handles all facets of the retiree healthcare side, because you need to bring it all under one roof. Because when you can have multiple professionals all sitting under the same roof, in the same conference room, visiting with you on how to seek improvement, that's how improvement gets done. It gets done through whiteboarding. It gets done through the process of listening to what's important about money to you, what's important to your family, what are the resources that are unique to your balance sheet, and what are the risks that are unique to your ecosystem, your vertical. Harness that all together. That's the intersection of reinstilling faith and trust with everyone who lost trust in the mainstream advice of the financial model. That's why we believe in the concept of a family office, because everyone deserves a family office experience their way. That's what we do, and we do it well. Connect with us, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. All right, more to come. I'm Craig Bolanos. This is In the Know on AM 560, The Answer.
Get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
When I think about the next year, 2025, I still believe in this soft landing. I believe in administration that's going to bring in pro-growth, deregulation, less burden. And what does that mean? I think we could have an unemployment rate that still stays well under 5%. I think we can achieve inflation that year over year, can't do anything about what happened, but year over year, we could end up kind of in the 2.6% range, which is where we're at now. I believe that stocks still should be a large portion of people's retirement nest egg. But I believe those stocks should include some level of alternatives, because I think lower rates, these political shifts, they're going to impact VIX. That's the measure of volatility. And incorporating alternatives into people's equity portfolio makes all the sense in the world going into 2025. From a geography standpoint, US will handily again outgrow and out-earn Europe and Japan. And that's why I think having the geographical footprint where the vast majority of your money is domiciled in the United States of America, that's the place to be. It doesn't mean you shouldn't own some developing international. It doesn't mean you shouldn't own emerging markets. But I think the U.S. needs to be your single biggest focal point for all the reasons we know. From a style and market cap, boy, we've been excited about the move we saw in small to mid cap stocks, but nothing is guaranteed. I think people should be rebalancing back to target. And up until the burden of proof has been met, large capitalization equity remains everyone's friend from an overweight standpoint. When it comes to bonds and comes to fixed income, the inflation piece means to me we continue to take a barbell approach, loading up on the short end of the curve, getting some bonds into that 5 to 7 year space. And don't forget preferred securities. We love the idea of that unique little hybrid security. It just makes all the sense in the world to enhance yields and cash flow. And speaking of yields and cash flow, don't forget that alternative investment that is cap and cushion, that alternative investment that is private credit for those looking to move into 2025 on a strong suit. If you want to get retired and stay retired, you want to make sure you thrive, you don't just survive retirement, connect with us. 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com.